Hi, I'm Sam Chandan, founder of Chandan Economics and the head of the Schack Institute at New York University. The team at Chandan Economics works very closely with Arbor to collect a very unique data set in the market that allows us to analyze the small balance multifamily sector. These are relatively smaller loans for relatively smaller properties that, in many cases, institutional research has overlooked. As the small balance market has grown, exploring the really unique dynamics of this marketplace. Who is the renter in the smaller property? What keeps them in that property? What are the sources of capital? How do we see the values of these properties changing as the interest rate environment changes? Those are all extremely critical questions that, again, we explore with Arbor as part of a research report series. And you can find that research, including weekly updates on market dynamics, our quarterly market trends report on the Alex Chatter blog. Chandan Economics and Arbor show that multifamily investment activity in the small balance space in particular reached $53.1 billion in 2018. That's the biggest number we've ever seen. And in part, it reflects a larger number of investors in the small balance market. Importantly, it also reflects a greater diversity of lenders that are participating in this market, an overall improvement in liquidity that we think will be exceptionally important to us as we think about how the sector will perform over the course of the next downturn and how it will perform over the course of the next expansion. When we look at the sector, a couple of things become important. One is that there is some cushion built into the cap rates today. Cap rates for the small balance space are not quite as low as what we see for multifamily overall. The other important thing is that we've seen a significant improvement over the course of this cycle in terms of the degree of liquidity in this market. A larger number of participants in the capital markets providing for equity and debt liquidity in the small balance space aside, the thing that really matters for us so much here is the underlying fundamentals. We've not seen a lot of new small balance space come online in the United States over the last several years, and that's really kept supply in check in a way that has made the market very tight, created opportunities for development, particularly as it relates to workforce and relatively more affordably priced market rate housing. Given the likelihood that we'll experience some period of softness in the economy, investors in small balance properties will certainly want to be careful to ensure that they've got that necessary cushion. That if there is a period of time where vacancy rates are a little bit higher, or more likely where effective rents might flatten or decline a little bit, that they have the capacity to really muddle through that relatively short downturn to then be well positioned on the other side of it.